Hello everyone. In this chapter, we're going to be talking about long-term decisions that business management has to make, and these are commonly referred to as capital investment decisions. Why would they call them capital investment decisions? Well, what is a capital asset? It's an asset that's going to be used in operations for a very long period of time. So it could be building a new production facility. It could be acquiring new production equipment. It could be doing the expensive research and development to launch a new market-changing product. All of these things require certain investment upfront, and that is your capital investment. And companies who only have a certain amount of money to work with can't undertake all possible jobs that they could take on. They have to choose which ones are going to be the best for them, and that process is called capital budgeting. It's choosing which long-term assets to tie the company's money in a way that maximizes the profitability that the company will achieve from undertaking all of these capital projects. So how does this all work? Well, first, you have to have a plan. You have to develop your long-term strategy. This is what we want to do with our business. This is the way we see our business operating in the next 10 years. And to maximize that plan, to make your business look the way that you want it to be, you need to figure out what potential projects can you undertake, what investments can you invest in. And you need to analyze through those, figure out what each one is going to cost out of the pool of funds that you have available for capital investments. And you need to ration that capital in the way that causes you to undertake the set of projects that maximizes your profitability. And from there, you act on your plan. You undertake all of those projects. So you buy all of the necessary equipment. You pay for all of the necessary research and development. You construct the necessary production facilities or shipping facilities, etc. And then things sometimes don't go to plan. So you have to do a series of what they call post audits, which means if we undertake this project, this is the amount of money we expect to bring in year one, in year two, or throughout the whole life of the project. Well, as that project is going on, you should always be checking to make sure it is indeed as profitable as you thought it was going to be, because if it's not, then you have to make a decision whether to abandon that project, funnel more money into that project to hopefully make it successful, or to accept it for what it is and realize that your profitability is not what you thought it was going to be, but you don't have a better decision alternative. So over and over and over again, it's the same thing. It is figuring out what your strategies are and acting a plan to maximize your company, acting upon that plan, and then auditing your plan to make sure it is living up to what you thought it was going to be. So we have all these different potential investments, and it can be thousands for a company. There's a lot of options that companies have. Well, how do you determine which sets of projects you should undertake? You need certain methodologies for analysis, and we're going to focus on 4 of them. They are payback, accounting rate of return, net present value, and internal rate of return. Not all methods are created the same. Some are much more detailed than others. Some require a whole lot more input to analyze with. So some are quick and easy ways to screen through techniques, and some of them are more detailed and time-consuming ways to really get down to what's going to happen if you undertake a project. For screening techniques, they're typically the ones that do not involve the time value of money. And by that, I mean they treat every dollar that something earns in the future equally. So a dollar, earned tomorrow is worth the same as a dollar earned 10 years from now. And 2 techniques we're going to look at that do not incorporate the time value of money are the payback method and the accounting rate of return method. Some of the more detailed methods require you to convert money into one uniform amount, essentially figuring out, okay, we're going to make this amount of money 5 years from now, but what would that be worth in today's dollars? Because by not having it today, you're giving up the option to reinvest it. Plus, that waiting 5 years from now, in 5 years, things are going to be more expensive than they are today, so each dollar is going to be worth less. So you have to convert future dollars into today's dollars using the more complex methods, and that's for us net present value and internal rate of return. So with these techniques, we are going to ration out our capital as effectively as possible in a way that maximizes our return. When we do so, our main focus is going to be on cash flows. What amount of cash is this project going to bring in? And companies focus on cash flows as opposed to accounting income, because there's a lot of things in accounting income which can increase your net income on the end line, but they don't actually increase your cash. You could have gains or losses on sale of investments that would affect your income, but it doesn't change the actual amount of cash that goes into your hand. So when you're doing analysis, your main emphasis for any type of capital rationing is going to be on cash flows. The revenues that you're going to generate from the investment, the amount of cash it's going to save you in operating costs if you have a new, more energy efficient machine, the amount that you can sell any equipment or any other assets that are directly associated with a project for when the project is over with, its residual value. Those are all things that are going to bring in cash. Paying for the equipment up front, having any additional operating costs. Maybe you have to hire more skilled laborers to run this machinery because your current laborers won't know how to, and then maintaining the machinery. Those are all things that are going to reduce your cash because they're going to cause you to have cash outflows. So as we're doing this, we're going to be looking at the amount of cash that's bringing in less the amount of additional cash it's going to cause us to put out, which is going to, the difference between those two is going to be our net cash inflow. And here it is in a little graphical form. Again, you make that big investment up front. Over the life of that asset's usage, you're going to have additional revenues that are generated, which are inflows. But you may have extra operating costs, which would be outflows. And then you have your standard maintenance, which would be a cash outflow until the project is over with. And any assets that were specific to that project, you will no longer need. And you can sell those off to the highest bidder, which will bring you that one final residual cash inflow when you dispose of all the assets tied to that particular capital project at the end of the project's life. So let's start with our two screening methods, which do not account for the time value of money. And the first one we're going to do is payback. And payback, simply enough, is how long is it going to take this particular project to pay us back, for us to recover an amount of net cash inflows which was equal to our initial investment. So let's say that Smart Touch Learning over here is considering investing $240,000 in the hardware and software necessary to start up a business-to-business portal. And a business-to-business portal is something that Smart Touch could have with its suppliers, where their two information systems are linked. So if Smart Touch gets low on a certain processor and they're buying that processor from a supplier, that supplier will see through their information that Smart Touch is low and will automatically send them those parts. And in doing so, it saves you a ton of money on purchasers. And in this case, Smart Touch Learning is going to expect to be able to reduce the size of their purchasing staff, their professional shoppers, and in doing so, save $60,000 per year for each of the 6 years that this business-to-business portal is going to be functional for. So we have our cash outflow up front, the $240,000, and our net cash inflow during the life of this is going to be that $60,000 per year, which our operating costs get reduced by because we have this business-to-business portal. To figure out payback, it's simply enough. You take your amount invested and divide it by your expected annual net cash inflow. And I will say up front, this formula only works if you have what they call regular cash inflows, which means it's the same amount each and every single year, which for our business-to-business portal is going to be true. We're expecting it to save us $60,000 a year for the next 6 years. Well, if this particular capital investment is going to cost us $240,000 up front, but it's going to save us $60,000 per year, after 4 years, we will have recouped in savings on operating costs exactly what we put in up front. So the payback period on this B2B portal is 4 years. It may not be the only option that Smart Touch has. They also have an option with this $240,000 they have available to upgrade the company's website. And if they do, I think it's going to be more attractive to purchasers. And in general, it's going to increase their revenues by $80,000 a year for the next 3 years, at which point all of the upgrades that they made to the website aren't going to be new and fancy anymore. And it's going to not help them with their revenues. But for the next 3 years, they expect to increase sales by $80,000 per year for each of the next 3 years, which means that if they put out $240,000 up front and it increases sales revenue by $80,000 per year, after 3 years,
paying to upgrade the website will recoup its initial investment and will pay back SmartTouch on the investment they made in here. So the website has a shorter payback period than that B2B portal does. They get their 240 grand back much faster. And as we can see here in a little chart form, the amount of cumulated net cash inflows that the company is going to have off of the two respective options that we've talked about so far gives it a payback period of 4 years for the B2B portal. That's when it gets to a total of 240 grand. And for the website, it's after 3 years. That's when they get to a total of $240,000 of accumulated net cash inflows. With the formula method that you saw on the prior slides, you can just divide it out and it'll give you the answer. But this methodology is incredibly useful when you have what they call irregular cash inflows, where your inflows aren't exactly the same every single year. Well, they are for these two options, so what else do we have? Well, let's say they have a third option for a Z80 portal, which I'm not quite sure what that is, but it's irrelevant to this discussion. All we know about it is that it costs $240,000, just like the other ones. In this particular investment will give us $100,000 back after year 1, $80,000 after year 2, $50,000 each after years 3 and 4 respectively. In years 5 and 6, it will save us $40,000 per year. And then at the end of its 6-year useful life, we'll be able to sell any of the necessary assets that we purchased to undertake the project of the Z80 portal for $30,000. So what we are focused on here is our accumulated net cash inflows. After year 1, it'll be just the $100,000 that we got in year 1. In year 2, we'll be saving an additional $80,000. So in addition to the $100,000 that we had before, we are now up to accumulated net cash inflows of 180 grand. After year 3, it's expected to provide us another $50,000 of net cash inflows, which means if we add that to the $180,000 we had before, we're now up to $230,000. After year 4, we're going to add another $50,000 in net cash inflows to the $230,000 we had, bringing our total accumulated net cash inflows from this Z80 portal project up to $280 grand, and so on and so forth. Another $40,000 in year 5 will bring us up to $320,000. Another $40,000 in year 6 will bring us up to $360,000, and another $30,000 in residual value for this particular project will bring us up to $390,000 in total. Well, this project is going to cost us $240,000 in an initial cash outflow. At what point do we break even? Well, it can't be 3 years, right? Because we were only at $230,000 after 3 years. But it's got to be less than 4 years because we'll have $280,000 of total accumulated net cash inflows after the 4th year. So some point after the end of the 3rd year, but before the end of the 4th year, we are going to break even. How do we figure out what our payback period is on this particular project that has irregular cash inflows? Well, what you do is you first denote how many years is it going to take you to get to an amount of accumulated net cash inflows that is as close to possible to your initial investment without exceeding it. So after year 3, we are at $230,000, which is as close as we can get to our $240,000 investment without going over, because after year 4, we're at $280,000. So we know it's going to take us 3 full years and a little bit of change. Well, it's going to take us another $10,000 in cash inflows during year 4 to get from $230,000 up to $240,000. So how do you do this? You take the last known amount of time in full years that you had to get to that point that is the closest you can get to an accumulated net cash inflow without going over. And to it, you add whatever you get when you divide the amount needed to get back to complete recovery to your initial investment by the amount of cash inflows you're going to have in total for that year that you know you need a part of. So back to our information here. We know we need $10,000 in cash inflows during year 4 to get us up to $240,000. We're going to have a total of $50,000 of cash inflows during year 4. So we need $10,000 out of that $50,000. That is 0.2 years, 1/5 of the year. So our payback period for the Z80 portal is 3.2 years. And then when we look at payback period, some would say shorter is always better. I'm not sure that's necessarily true, but for in our case, if that's what we were thinking, the website's the best. It has the shortest payback period of 3 years. The Z80 portal is at 3.2 years, and the B2B portal is at 4 years. There is a problem with this, however, and this is why it's just a screening technique. All we're looking at using this payback period is how long does it take us to get our money back? But it's not asking the question, how much additional money are we going to get after we recoup our initial investment? See, the website was the shortest at 3 years, but there was no additional cash inflows after that payback period. We would have taken on this website project, paid back exactly what we put into it, and made no further profit from it. So, taking that into consideration, the website, even though it's the fastest to pay us back, doesn't look like our best potential investment. The Z80 portal was at 3.2 years, but it had $150,000 of net cash inflows after we recouped that $240,000 that we put out in the first place. So some could look at this and say the Z80 portal is actually the best investment, which is why the payback thing is just a screening technique. You don't want to use this methodology purely for determining your decision. All it is you're looking at it, and the company will set a certain payback amount of time. They will say any project we undertake has to pay us back within 3.5 years. And if you go through and you run the payback for a potential project, say like the B2B portal, that doesn't meet that requirement, you disregard it and you whittle down the amount of potential projects you have from a potentially huge number to a smaller, more manageable number, where you can do the more complex and mathy analysis techniques to actually figure out which set of projects is going to maximize your income. So that's the payback rule. There is a number that has been set by your company, which is the amount of time that all payback projects, or the payback period that's acceptable for all potential projects. And if you're going to recoup your investment faster than that cutoff line, you should invest, or you should at least, no, I shouldn't say invest, you should consider taking that project on. It passes the screening technique. If a particular project has a payback period longer than that cutoff point that your company has sent forth, well, there's no, reason to proceed. It has failed this particular screening technique, and you disregard that potential investment. Accounting rate of return is also another similar screening technique, and basically this question asks, what portion of our average investment are we going to get back each year? Are we going to get back 20% of what we had to put in up front each year, 30%, whatever? So the accounting rate of return basically figures out what portion of your original investment are you going to recoup each year via your increase to operating income. And you do so with the formula that is listed here. So we need to first figure out what the total operating income is during the life of this project. And that would be the net cash inflows in total that you get over the entire life of the project, less its cost. And when you figure out its cost, it's how much, in this case, depreciation you're going to have on the asset. So how much you have to spend on the first day, its historical cost, less how much you're going to be able to sell and ultimately get back at the end for that equipment. So cost minus residual gives you your total depreciation. When you take your total net cash inflows for the project's life, subtract out your total depreciation, you get your total operating income during the project's life. But we don't want to have our total income for the life of the project. We want to have our average annual operating income. So we need to take that total operating income over the entire life of the project and divide it by its operating life in years. So in this case, we have the B2B portal. The B2B portal, if you'll recall, was going to provide SmartTouch with $60,000 of net cash inflows each year for the next 6 years. That's a total of $360,000. It was going to cost $240,000 up front, and the assets that we need to acquire to undertake this B2B portal project have zero residual value, which means we have to spend $240,000 up front to undertake this project. We're not going to get anything back at the end. The total cost or the total depreciation of this project is going to be $240,000. So it's bringing in $360,000 and costing us $240,000. That means it should increase our company's operating income by $120,000 for its entire 6-year life. We'll figure out how much on average that's going to increase our operating income by per year. We just divide it by the operating life of the asset, which was 6 years. So $120,000 divided by 6 gives us average annual operating income of $20,000. And if we want to figure out what its accounting rate of return, its ARR, is, we take the average annual operating income right here and we divide it by the average amount invested. What is the average amount invested? It's how much you're going to have tied up on the project in the first day, how much you're going to have tied up on the last day, and it's the average of those two numbers. And to find it, you take your initial investment, which in this case was $240,000, add to it your residual value, which for this particular project was zero. So this equipment that we have is going to be worth $240,000 on day one, and zero on the last day of the project, which means the average of those two numbers is $120,000. So 20,000 divided by 120,000 gives you 16.7%. Essentially, you're going to be recouping 16.7% of what you have invested on any given day each year during the project's life. Let's do the same calculations for the Z80. The Z80 is also going to give us $360,000 in cash flows over its life. Well, let's subtract from that its cost. And the Z80 portal costs $240,000 up front, but we think we're going to be able to sell it for $30,000 on the last day of its useful life, which means in total, when we consider that we're going to get $30,000 back, this project is only costing SmartTouch $210,000. So if they're getting $360,000 in cash flows and the total cost is $210,000, this is going to be expected to increase operating income by $150,000 over the entire 6-year life of the project. And if that's $150,000 for 6 years, that means that on average, undertaking the Z80 portal is expected to increase SmartTouch Learning's annual operating income by about $25,000. To figure out our accounting rate of return, we take that average annual operating income increase that we get, and we divide it by the average amount invested. So what we're saying here is that this project has the equipment associated with this project has a value of $240,000 on day one, $30,000 on the last day. We need to find the average of those two numbers, so we add them together. $240,000 plus $30,000 is $270,000. We divide that by 2 to find the average of those two numbers. That's $135,000. And then if we take our average annual operating income of $25,000, divide it by the $135,000 average amount that we have invested, we come up with 18.5%. So SmartTouch, if they undertake the Z80 portal project, will have an increase to their operating income each year of about 18.5% of what they have invested. So what's a good number or a bad number for accounting rate of return? Entirely dependent on the company. The company's management will set forth a policy. This is all projects that we are going to undertake have an accounting rate of return of, say, at least 17%. Well, if you go through then and you do the calculations and you have a potential project that has an accounting rate of return greater than that amount that the company has set as its minimum, you can undertake that project, or you at least passes the screening technique and you can go through and do some more complex calculations. If it has a rate of return that's underneath 17%, like the B2B portal does right here, well, then it didn't meet your screening criteria and you would disregard that project. So for ARR, is the ARR we determined for the project up to the standards of our company? If it is, pursue that project further. If it's not, you elect and you're not going to invest in that project. You disregard it and you go on and you choose from some of your other alternatives.